There we go. Okay. Hi, everybody. Hope you are doing well. Today, we are going to talk about taxes. I know that this is certainly a topic that many of you have a special interest about. There's so many important decisions that we that we had to make when filling out the taxes. And today I am here with our nice colleagues from Bright Tax, and today with Melissa. So I'm very excited to talk about this topic uh, because due to the relevance, certainly. And you can see that people are joining in. That's amazing. We have Kent, Christine, Marian, Lila. Nice to meet you. And guys, feel free to post a comment in the comment bar. And yes, if you can tell me where you are from, that would be fantastic. Stephen, Michael, we have James in Portugal. I can see that there are people who did move to Portugal already. Some of them are probably in the process of moving. So we have Jessica from Los Angeles. Yeah. So there's some familiar faces here. We have friends, Debbie. Yeah, I can see that most of you are based in the US. Hi, Debbie. Bruce, my friend Bruce. Yeah, so today finally we were able to set up this important webinar and with the best one that we can find. And usually we spend just around 5 minutes until we start the presentation, just for you people to arrive. And just as you know, this webinar will be recorded, so you will receive an email after we come to the end of it. So if by any chance you're not able to go through the whole webinar, that's no problem. You will still be able to watch the content. But yeah, Michael from San Diego. So John planning to retire in Portugal. Yeah, that's a nice plan. I myself am also an expat. I didn't move to Portugal for retirement, but I plan to retire here. It's a nice place. It's a very chill environment, nice people, and overall, I guess just a nice place to live. Hi, hello, Miracle. Yeah, so some clients are here. That's amazing. And so I guess we can start. And I of course would like to introduce our colleague Melissa. And Melissa, if you want to talk a little bit about yourself, and then we can move on to the slides. I will try to be as participative as I can because I do have some questions as well, but I'll leave the microphone to you.
No problem. Thank you. Thank you guys for having me. Hi, everyone. My name is Melissa Groves. I'm a CPA here at Bright Tax. Bright Tax is a tax firm that assists expats with their U.S. tax filings. I am personally based in Germany. My family moved here 4 years ago. Before that, I was in Texas, Ohio, South Carolina, New York. So yeah, I lived in a couple of states, and now I'm an expat myself, living the expat dream. And like the rest of you, or those of you that will move this side, will have to file my U.S. taxes while living abroad. The presentation is probably about 20 minutes. I plan on leaving enough time for questions. I will put the disclaimer out there that some questions will need to be done on a one-on-one basis. So depending on what your question is, if it's general enough, I'll do my best to answer. But for the ones that are extremely specific, I'm just going to be upfront from now and say I will push you to talk to a professional, whether it's one of us here at BrightTax or another CPA that you know. So with no further ado, let's get started. And can you see that?
I can't. Let me try to. I'm also not.
Okay.
Oh, like.
Perfect. There we go. Okay. So for today, it's just 4 quick areas that we're going to go through. Filing essentials, avoiding double taxation, reducing your tax bill, and planning ahead, which is a great start for a lot of you because I see that many of you are still based in the US. Especially for those in the US, most of you know that every year you are required to file a tax return if your income is at a certain threshold. The 4 main areas for filing are for individuals that are single, that is, you are unmarried and you don't have any dependents. For you, your filing threshold for 2024 would be 14,600. For those that are married and filing jointly, your filing threshold is 29,200. For my head of households, that is, you have a dependent that you're claiming, the filing threshold for you is 21,900. And for those that are married filing separately, and for whatever reason, whether you're married to another American and you guys have chosen to file separately, or if you're one of the lucky few that you're married to a non-American and then you're choosing to file married filing separately, your filing threshold is $5. If you are self-employed, this is very, very important because I have clients that go, oh, well, I didn't make 14,600. I'm self-employed, so I didn't file. That's not the case for those that are self-employed. If you earn just $400 of self-employed earnings during a calendar year, you are required to file a U.S. tax return. That is whether you're domestic in the U.S. or you're living overseas. Important to note, bank account reporting requirements for US citizens. And if you're living in the US or you're living overseas, this is still an important requirement. For all US citizens or green card holders, if you have a foreign bank account, pension, banking, checking, savings, retirement, if those add up to more than $10,000 in any given year, you're required to file what's called a foreign bank account report. This can be filed independently by yourself through the US Treasury's website, or it can be done through a professional. I like to use this example. If you have a bank account, say in Portugal, that you opened on January 1st, and you put the equivalent of 5,000 US dollars in that account, and later in the year, you open another bank account in Portugal or Spain or Italy, and you take $3,000 out of the first bank account and you move it to the second account, you now have 2,000 in the first account, 3,000 in the second account, still $5,000. Later in the year, you decide, you know what, I want to move some money to another bank account, and you open a third account. Could still be in Portugal, Italy, Spain, doesn't matter. So you've now taken 2,000 out of the second account and you've moved it into the third account. So you have 2,000 in the first account, 1,000 in the second, and 2,000 in the third. Still $5,000. However, from an FBAR perspective, that's the foreign bank account reporting perspective, you have an equivalent of $10,000 because it was 5,000 in the first account, 3,000 as the highest in the second account, and 2,000 as the highest in the third account. Aggregated, sum together, that's $10,000. You've hit the threshold. It's important to note that this is not a tax situation. You're not being taxed on that money. It is just a disclosure. Yes, I know, Tommy, very unreal. It is, but it's just a disclosure. So Uncle Sam isn't taxing you, Treasury isn't taxing you. It is just a disclosure. However, if you fail to do this disclosure, you could be fined up to $10,000. So it's important to make sure that this form gets filed, whether you're overseas or living in the US. If you have a bank account or financial assets outside the US, be sure to do this filing. The secondary filing, and this one goes with your tax return to the IRS, is the FATCA disclosure. This one is, the thresholds are different, so it's important to pay attention. If you're living in the US, the threshold is 50,000 if you're single, or 100,000 if you're married filing jointly. And if you're living overseas, it's 200,000 if you're single, or 400,000 if you're married filing jointly. And again, this is just a disclosure statement. You're not being taxed on the money sitting in your bank account. This is not a wealth tax. It is a disclosure statement. Filing deadlines. For those living in the US, you know April 15th. Everybody's aware of that. And of course, if it falls on the weekend or if there's a holiday, then it extends to the very next working day. So it could be the 16th, could be the 17th, but the deadline is the 15th of April. If you are an expat, that is, you're outside of the US on April 15th, you get an automatic 2-month extension to June 15th. What's important to note here is that it's an extension of time to file, not an extension to pay. That's very important because while the IRS gives you additional time to gather your information to file your tax return, if you owe taxes, interest is still being accrued between April 15th and June 15th, but there's no penalties being accrued at that point. Penalties start to accrue after June 15th. Whether you filed an extension to October or not, penalties start to accrue on the balance that is due. So as a US citizen, you have until April 15th if you're in the US. If you're outside the US, you get an automatic 2-month extension to June 15th. And everybody has the option to file for an extension to October 15th. That's in the US or outside the US. But for those of us outside the US, we have a secondary, well, I guess third at this point, third extension option, and that is to file by October 15th. It's the 16th this year because the 15th falls on the weekend. But that extension, it's not automatic and you can't apply for it the day off. It has to be a written request sent in way in advance of October 15th to give you until December 15th or 16th for this year. Oh, this is important stats. Did you know that there are about 9 million people living outside the US, and a lot of them are not aware of the fact that they need to file a tax return? Okay, I'll come back to that. Go ahead and send your questions in. I'm actually gonna turn off the comments from seeing them, so I'll get to those at the end. For whatever reason, there are a lot of people who've either been misinformed, weren't informed at all, or just didn't know that as a US person, you're still required to file your return, even when you're living outside the US. Even if you don't have US income, you're still required to file. So happy for all of you that you are aware of that before you move, or now that you've moved, you've been made aware. And if you are in that position where you didn't know, if you're somebody listening today and you didn't know that you had to file, don't worry, there is reprieve for those. The US has a streamlined filing procedure that my colleagues and I will be happy to support you with to help you get caught up And if you have any family members or friends that have been living outside the US for years and haven't filed, they don't need to panic either. There's still the opportunity to get tax compliant. Avoiding double taxation. If you've been following any news or any blog posts, you know that there's tax treaties that help to prevent double taxation. For those of you who are planning to move to Portugal, the US and Portugal have a tax treaty. What a lot of people aren't aware of is the fact that there is a little verbiage included in all the treaties that pretty much says the US reserves the right to tax you as though the treaty were never in existence. So in the industry, we call that the savings clause. And pretty much what it is like I said before, yes, yes, yes. If you live in Portugal, this is taxed in Portugal. However, we reserve the right to say the treaty didn't exist, so we can still tax you in the US. That's why it's important, depending on the income stream that you have or what you're doing, to consult an advisor on both sides. I have a lot of clients that think, oh, it's only important to talk to the advisor in the foreign country, or I only need to worry about my US taxes. I think it's important to have somebody on both sides, at least the first year or two that you move. It's really helpful to have that. And here, they'll get the slides at the end, right, Victor? I think so. So there's just some verbiage here that you guys can refer to for different misconceptions. Now, for what I think most people care about is when I file my tax return, how do I report my income? What can I use? How do I reduce my tax burden? The two main options is either using the foreign tax credit or using the foreign earned income exclusion. Starting with the foreign earned income exclusion, earned income is different from passive income. What that means is if you have interest income, dividend income, pension income, any kind of retirement income, that is not earned income. Those are treated as passive. Earned income would be wages. So if you receive salary payments, if you're self-employed and you have freelance income or self-employed income, those are earned income. And you have the option as somebody with earned income, you get to exclude up to, for 2023, 120,000. I believe for 2024, it might be, I think, 127,500. You get to exclude that from income. Important to note, excluding it from income means you still have to file a tax return to show that. I've had several clients go, oh, my income is below the earned exclusion, so I didn't file a tax return. No, the reason for not filing a tax return is if you're under the standard deduction, but if you're under the earned income exclusion, you still have to file a tax return to show the IRS that you're under the earned exclusion. However, if your income is above the earned exclusion amount, or you live in a high tax country, it probably benefits you to do the foreign tax credit. And what that is you get to file your return and you include form 1116 that shows to the IRS, I've already paid 25% tax to Portugal. I've already paid 30% tax to the UK. I've paid 32% tax to Germany. So now I get to reduce my US taxes by the taxes paid to the foreign country. You don't get a refund from the IRS for the taxes paid to a foreign country, but what it does is reduces your US tax obligation. So for example, if you're living in Portugal and you've paid 20,000 in taxes to Portugal, and when you prepare your US return, you would have owed 18,000 to the US, you get to take a credit in the US for the 20,000 already paid to Portugal. That 2,000 difference, you get to carry that forward for 10 years to use in future years to offset future foreign income, foreign earned income. So you can't use your Portuguese taxes to offset your US W-2 if that US W-2 wasn't taxed in Portugal. Or you can't use your Portuguese taxes to offset your US pension if the US pension wasn't taxed in Portugal. I hope that makes sense. And again, this is just more details going through what I talked about a while ago. Now, reducing your US tax bill. For those who still have dependents, whether you're in the US or outside the US, you still qualify for the child tax credit. Please note that you do not get the benefit of the child tax credit if you use the foreign earned income exclusion. So the child tax credit can only be used for individuals using the foreign tax credit. If you've opted for the foreign earned income exclusion, then you don't get the child tax credit, and you also don't get the refundable portion of the child tax credit, which is a max of $1,600, and that stops when your child turns 17. For those that might be self-employed, if you're in the US, you're very familiar with self-employment tax. If you've already left the US and you're thinking about becoming self-employed, it's important to note that you may still be responsible for self-employment tax in the US, and that is Social Security and Medicare. It comes to about 15.3%. Sorry about that. It comes to about 15.3%. Can you still hear me, Victor?
Yes, perfectly.
Okay. With the self-employment tax, that is on your freelance income, your self-employed income. However, if you live, the US has an agreement with about 30 countries, 27 to 30, I lose count sometimes, that if you've paid social contributions to that foreign country, here's the list of them. Sorry, it's coming through a little weird. But if you've paid social contributions, or you live in these countries and pay social contributions on your self-employed income, then you will not owe self-employment tax to the US. So for those of you thinking of going to or living in Portugal, Italy, Spain, most of Western Europe, some part of South America, I believe there's one. Yeah, Brazil, Chile. So I would take a look at this list. If you're not planning on being self-employed, then you can disregard this section. But for those of you who are business owners or planning to start your own business, specifically sole proprietorship, this is important to know. I like to use Australia and New Zealand as my examples. Somebody who moves to Australia starts doing freelance, they pay self-employment, they pay social contributions to Australia, they file their US return, they don't owe additional taxes. However, somebody in New Zealand does the exact same thing. They pay social contributions to New Zealand, file their US return, and still have to pay self-employment tax to the US because the US and New Zealand don't have this totalization agreement. So if you're considering doing freelance work while living overseas, be sure to double check if the country that you're paying taxes to is one of the ones that the US has this agreement with. If not, you are going to find yourself owing self-employment tax in both countries. Proactive tax planning and business structures. One of my favorite things to actually talk about and have conversations with, just because it's really hard a year after now, a year later to go, oh, hey, you know, I moved to Portugal and I decided to start a business. And yeah, the business is really profitable. And then I get to say, well, based off how you structure that business, here's the amount of taxes you owe in the US. And you go, but I've already paid this much tax to the foreign country. Why do I also owe the US? That's why it's important to have those conversations up front with both the US advisor and the foreign country advisor to avoid those pitfalls. There are some cases where you're not able to eliminate double taxation, you're not able to eliminate having to pay tax, but you can minimize depending on the structure that you have. So my recommendation is before you make a big decision like starting a business, closing a business, getting in a partnership or a corporation, anything of that sort, be sure to have a conversation with a tax advisor, a reputable tax advisor. And here, I talked earlier about the penalties for not filing the FBAR or FATCA. There's also penalties if you have a foreign business that you have not disclosed to the US. So even though you're living overseas, you are still Uncle Sam's baby, and Uncle Sam wants to know what you're doing. So if you decide to open a corporation or a partnership or a trust in a foreign country, there is a disclosure document that will have to accompany that filing. Even if your ownership in that entity is only 10%, you still have a reporting requirement. It could be a one-time reporting requirement, or it can be a continuous reporting requirement. But it's important to note that failure to file these forms could result in some very huge penalties. I think I beat this one already, telling you guys plan. And that's why a lot of you are here, right? Is to get the information to make sure you don't fall into that. So I will now open it up for your questions, which I think you've already started.
Thank you. Melissa, if you want to, I can help you with the
Yes,
questions, but just
please.
before talking about them, oh, such amazing information! Really, I try to interact with the guest, but it was such important information. I was just taking notes here. Thank you, thank you for
You're
providing that.
welcome.
Really appreciate it. You did go over those topics in a so like fluid way, and because that's very important and very technical. So I would like to thank you. And of course, we will go over the questions. Before that, I highly encourage you guys to talk to Melissa and her team, because especially when we talk about taxes, like we don't know what we don't know. So sometimes it's better to just be like in a situation where you feel comfortable on when you start engaging with business here in Portugal. Uh, it's better to not go to that stage where you will go through some fines because you didn't just want to go and find information that's related. So yeah, and I can see that you have many questions. Uh, we have Melissa and Lila on the backstage helping us with the structure here. And I don't know, Melissa, how you prefer to deal with the questions, if you want to choose them. And of course, we will leave our contacts here. If we're not able to answer all of them, you can certainly reach out to us. Melissa will also share her email, and we will be able to address those questions in time. There you go. So that's the place where you can email us. But yeah, whatever you prefer, Melissa.
Yeah, I'm gonna try to go one at a time. Michael, I'm so sorry. I love your name, by the way. That's the name of my son. But your question, whether or not to move your business, your consulting business, that I think is a conversation that should be done offline between yourself, a US CPA, and a Portuguese advisor, because it's going to be important. It, there are other things to consider, and honestly, it would be unprofessional of me to answer that in this capacity without knowing everything that's involved. So I would recommend having a consultation with both parties present. Stephen, live in New York, but plan on moving to Portugal in a year. I know that I have to continue paying both US and New York taxes since I won't be living in the US anymore. Should I change my US residency to a state like Florida? Actually, thank you for that question because I saw somebody earlier saying they were in Virginia, and I wanted to remember to say New York isn't as bad as Virginia. If you're living in the state of Virginia right now and you're planning on moving overseas, please note that the state of Virginia, people call it a sticky state. I don't know if sticky is the word that I would use, but Virginia says if you belong to me and you leave me and you go overseas, you still belong to me. So whereas New York, California, other states are like, oh, if you no longer live here, then you file a non-residence return, you file a part year return or a non-resident return in your final year, and you break ties and you're gone. Virginia says unless you've taken residency in a new state before leaving the country, you still belong to me. So if you're in Virginia, you might continue to have a filing requirement, regardless of if you leave the country 16 years later. I mean, if you've been living out of the country for 16 years. So I would double check with, I would try to move out of Virginia before leaving the country. But Steve, for you specifically, um, like you can try to move to Florida. I don't know that you have to because each state is different. What's important to note is to look at the state's requirement because if you're not living in the state when you earn the income, then you probably don't have a state filing requirement. So I won't speak, except for Virginia, I won't speak to any other state specific filing because each state is different. But most states, if you've been living outside the state for a reasonable amount of time, you no longer have a filing requirement. Capital gains. Are capital gains from stocks or dividends from a brokerage based in the US taxable? That is going to be for a Portuguese advisor to answer, whether you're taxed in Portugal. So at BrightTax, we only address the US filing and your US obligations. We don't confirm or we cannot speak to what your obligations are to the foreign country.
And that's
Because the US,
sorry, Luis, that's where we can like have a complementary services. We can refer to some good tax lawyers and accountants here in Portugal. So if it's a question related to the US tax, you can reach out to Melissa. If it's a tax related to Portugal, you can contact us.
right. And does the US Portuguese tax treaty mean fees are taxed by the US at a different rate? So in the US, your tax rate is based off your overall income. So at a high level, for example, if your tax rate in the foreign country, so for example, if your tax rate in Portugal is 12%, but your tax rate in the US is 15%, then you would pay your 12% to Portugal, file the US return and claim the 12%, and then pay the difference of the 3% to the US. And if the reverse is the case, where your tax rate in Portugal is 15%, but your tax rate in the US is 12%, you would pay your 15% to Portugal, file your US return, and claim the taxes paid to Portugal, and most likely not have a US filing obligation. I do want to note, though, because we're talking about capital gains, the US does have a 3.8% surcharge on investment income. That is the net investment income tax. That 3.8% is typically not, you typically cannot offset it with foreign tax credits. I say typically because in France you can, but in most other countries you cannot. So even if you've been taxed in the foreign country on your capital gains, on your dividends, on your interest, and you've paid the taxes there, you most likely could wipe out your US income tax, but you could still possibly have the 3.8% net investment income tax. Rent is not an active income. No, it is passive. And it's the 120,000 exclusion of income net or gross. It is gross. So for those of you, so for self-employed individual, if you have $150,000 of gross income or yeah, gross income, and you have 30,000 of expenses, now your net is 120,000. Unfortunately, that does not mean you get to eliminate the entire 120 using the exclusion. The 120 is on the gross, not on the net. Oh, okay. Are distributions from a traditional IRA or a Roth IRA taxable in Portugal? Again, I cannot speak to what's taxed in Portugal. Sorry. Thank you, Lila, for sharing my information. Utilizing a virtual address. I have a lot of clients that use a U.S. address. What I will say about so when you file the U.S. tax return, you have the option on the face of the return to put an address. There's no stipulation really as to whether or not you have to use your foreign address or if you have to use a US address. We recommend using an address where, should the IRS send you a notice or try to correspond with you, that it is a reliable address where you'll be able to get that mail. That's the most important thing about the address on the tax return. The other thing, though, and I've seen this happen recently, I've had new clients that we've taken on where they've gotten notices from the IRS where they filed their return after April 15th and they were assessed penalties for late filing, even though they filed before June 15th. And that's because there was nowhere in the return where they noted to the IRS that they were living overseas and qualified for the qualified for the automatic extension. So if you are using a US return and you're filing after April 15th, but before June 15th, if you're using us, then you don't need to worry about it because we'll do it. But at the very least, I would recommend be sure to notate on the tax return that you're a taxpayer abroad. Once you have left a state, if you still have income from sources within that state, you have a tax obligation. Yes, that is correct, Debbie. Thank you. If there's income in the state, so earlier I mentioned that if you've moved out of the state and you're not earning, I think I did say you're not earning income there, but if I didn't, thank you, Debbie. I do want to clarify. If you have income that you're earning still in that state, so a good example is if you have a rental property in New York, you will still have a filing obligation in the state of New York. But for those who move overseas and you don't have income in that state, you most likely will not continue to have a New York filing obligation after leaving New York and not earning income in New York. I have a retirement pension from the U.S. military that is non-taxable income. If your income is non-taxable when you're in the US, it's non-taxable when you're outside the US because your filing obligations as a US person remains the same. So yes, Michael, you'll still have to pay taxes in California, or you still have a filing obligation in California. Whether or not you pay taxes, I don't know. I don't like to say you have to pay taxes. I like to say you have a filing obligation. Depending on what the overall income is, will determine whether or not you have to pay taxes in that state. But yes, you still have a filing obligation. Are those all the questions?
You did.
Easy.
You did very straightforward answers. That's very good. I can see that many people are from California, and yeah, that's kind of, I guess it's kind of a trend that people that are moving to Portugal. And guys, thank you for the questions, Melissa. Thank you so much for the very like nice and insightful answers. Um, you can contact us again if you have any question, or of course if you want to enroll with Brightex, you can contact Melissa. If you can leave a note that you came from this webinar, that would be really nice. And Lila also pinned our email. If you have any question regarding Portugal tax. And I can't thank you enough, Melissa, for the
My
insightful
pleasure.
webinar. This is our first one, probably first of many, because it's really nice to see so many questions, and it just proves that this is a topic that people they need to clarify those doubts, and knowing that people are doing their homework, coming to this webinar to get information. It's very nice to see. So thank you, Lisa. Thank you,
You're
everybody. We
welcome.
are here to help you. Thank you.
Thank you, guys.
So